Thank you very much, Manuel. I'm very happy to be with you today. It's a very important topic. We all know that really time is ticking away very fast. The climate crisis and the pandemic have really made it very clear that our current global system is unsustainable. And I'm going to talk to you today about how impact investment can go towards meeting the goals of the Sustainable Development Goals by 2030. I think really one of the most important things to recognise is that now more than ever, the SDGs are not aspirational goals, they're actually survival targets. And failing to meet them will have huge ramifications, not just environmental, but economic, financial, social. As Mark Carney says, those that fail to adapt will fail to survive. And it's really as critical as that. And I think we've seen massive changes. I mean, not just over the last year in response to the pandemic, but already we were seeing huge momentum building behind the SDGs and huge changes in the global economic landscape. So we know there are sort of push-pull effects. We know that consumers, savers, investors, their preferences are changing. A big piece of research a couple of years ago showed that 70% of the UK public wanted their investments to avoid harm. And that's incredibly important, particularly for younger generations, where 85% of millennials want their investments directed towards sustainable or responsible investing. And that's coinciding with enormous pressure and building pressure from policymakers and regulators. So across the globe, in the UK, in the EU, elsewhere, you've got a range of regulatory changes and policy changes that are really putting pressure on organisations and individuals to change. You've got the EU Action Plan on Sustainable Finance. You've got things like the UK Companies Act with its added emphasis on responsibility of directors towards all stakeholders. You've got changes in UK pensions regulation. You've got stuff going on at the UN and at the international level on sustainability standards. You've got TCFD, for example, which the climate-related financial disclosures framework, which in the UK is going to be mandatory for all companies to disclose using TCFD by 2025. So you've got some really big push and pull factors that are coinciding to build momentum to the achievement of the SDGs. So where do we come in? Where does impact investing come in? So I run the Impact Investing Institute, and we're a non-profit organisation which is trying to accelerate the growth and also improve the effectiveness of the impact investing market, both in the UK and internationally. And really, where we come in with the SDGs is that we know that to achieve the SDGs by 2030, there needs to be a massive mobilisation of capital, not just private, not just public capital, but also private sector capital. And that capital needs to not just take ESG factors into account to think about the environmental, social and governance factors that they need to consider to mitigate risk, but also to actually use that capital in a positive way so that it contributes to global goals. And impact investments are investments made with an explicit intention to generate that positive, measurable social and environmental impact alongside a financial return. And the important bit is that the capital is intended to contribute to the well-being of people and planet alongside the financial return, rather than just using ESG as a filter, as a way to avoid harm or mitigate risks. And impact investments are hugely diversified. They cover multiple sectors, many asset classes across private and public markets globally. And it is still small, the impact investment market, but it's experiencing very, very rapid growth. It was around $100 billion worth, the whole market back in 2017, and it's more than quadrupled since then in the last measurement of the market in 2020. So how does impact investment contribute to the efforts and accelerate the efforts to achieve the SDGs? Simply put, it directs capital into environmental and social solutions. So if I give you a few examples, that'll perhaps bring it to life. whether it's renewable energy, waste management, carbon capture technology, agriculture, sustainable agriculture, social housing. And that kind of investment does not mean that you need to sacrifice financial returns. And we're building an evidence base of impact investing opportunities in the UK and in emerging markets across asset classes, across sectors, to demonstrate that the two can and absolutely do coexist. So if we take the social housing sector as one example, obviously got strong positive impact credentials, but also attractive financial characteristics. But social housing providers and regulators have not tended to focus on measuring and demonstrating their positive impact and those positive benefits. So we've done a really in-depth quantitative analysis of the risk-return characteristics of social housing, which concludes that the sector's attributes really do justify it being included in a portfolio that would try to achieve strong and stable risk-adjusted returns alongside that positive impact. I mean, impact investment, just to be clear, it's not an asset class, it's an approach. And we really want to try to build a culture of impact consideration across the investment chain. We think we're moving to a world where all organisations will ultimately have to account for their positive and negative impact, as well as their financial performance. One of the ways that we're trying to help spread understanding of this approach and this need is through a learning hub that we have on our website, which I would urge you all to have a look at. And the Learning Hub offers a bank of resources which really are designed to help organisations and individuals learn more about impact investing. So why is that approach? How does that approach help with the SDGs? Well, I think the SDGs really highlight that environmental, social and governance factors are all interlinked and all interdependent. If we think about some of the goals themselves, like SDG 11, which is around creating sustainable cities and communities, or SDG 8, which is decent work and economic growth, you can really see how there's an interlinkage there of different social factors, but also with environmental and governance factors. And global efforts really so far have had quite a clear focus on climate action. But we really believe that environmental action must be taken with a social lens, that we must take into account the impact and the consequences on people and communities of the transition to net zero, and make sure that that transition is a just transition. What do we mean by that? We mean that the move to a net zero economy must be inclusive, it must be socially beneficial. It mustn't just contribute to things like SDG 13 on climate action and SDG 7, affordable and clean energy, but also things like decent work and economic growth and sustainable communities and reduced inequality. And this approach shaped our development of our Green Plus sovereign bond proposal, which we developed last year in partnership with the Green Finance Institute and the London School of Economics. And that concept of a green plus gilt, a green plus sovereign bond, is a green sovereign bond, but which has explicit and well-defined social co-benefits for each of its environmental aims. And obviously we were hugely pleased that the UK Chancellor announced a series of sovereign green bonds that would start being issued this autumn, and that the proceeds of those bonds, that the Treasury will report on the social benefits of that spending. So we're building on that work to think about developing more just transition financing vehicles which deliver those just transition outcomes, which mobilise private sector capital at scale for those outcomes, as well as a framework for measuring and reporting on just transition outcomes. So it's very important to recognise that the scale of change required is absolutely huge. We've got now less than 10 years to achieve the SDGs. And in order to achieve these goals, we need to mobilise capital at scale. That means at the Institute, we've got a big focus on large pools of capital, so pension schemes, many of which in the UK and globally are finding competitive investments across a range of sectors and asset classes that provide capital growth or income or diversification as well as a positive impact. And we've published some four good governance impact investing principles for pensions and other big pools of capital, which really help fiduciaries or other investment advisors and managers, give them really practical guidelines on how to pursue an impact investing strategy. And we've got an adopters forum, which is our way of keeping those principles alive and grounded in practice. We run that in partnership with Pensions for Purpose. And we've got 5 adopters and supporters so far, and have a strong pipeline of others, including some of the UK's largest pension schemes. So we also believe around that what investors and individual needs are also clear reporting standards which enable them to compare the outcome of different investments transparently, make them able to hold asset managers and asset owners to account for the impact that they deliver. And we're strongly advocating for mandatory outcomes and impact reporting, not just for ESG factors for risk mitigation. So let me summarise. In order to achieve the SDGs, we need to mobilise more capital at scale, both public and private, so that it contributes positively to the well-being of people and the planet. And that means moving beyond an ESG framework approach that just seeks to mitigate risks and avoid harm. Impact investing is a way of mobilising that private sector capital at scale to achieve the SDGs. And impact investing does not mean sacrificing financial returns, and we're doing work that demonstrates this to investors. We need to mobilise that capital at really significant scale to get the amount of capital that's needed to achieve the SDGs, and that's why we have a big focus on pension funds and other owners and managers of large pools of capital, as well as work designing and advising on impact finance vehicles at scale. And we need transparent, consistent, comparable impact measurement, management and reporting if we're to achieve those global goals. And those need to go beyond a narrow focus on climate to encompass social as well as environmental outcomes, those that are needed to achieve a really just transition to net zero. And the SDGs highlight that environmental, social and governance factors must be recognised as interlinked and interdependent. And they're not now aspirational goals, they are our survival targets. Thank you very much.